welcome the module on Indian banking system key reforms. This goes back to the role of the banks in any economy or a nation. Banks are basically the financial institutions which have the responsibility of channelizing savings to capital formation and finally to investment. So as we identify the major role of the banks for the development of the nation, firstly we discuss on the concept of capital accumulation. This is basically inherent in the savings accumulation of a country, which comprises of both public savings and private savings, which are channelized with the help of any financial institution, namely banks or financial intermediaries. Secondly, the savings can be encouraged also to stimulate the growth, which will take up the financial health of a nation or also explain the responsibilities that the banks can perform. Moreover, the capital mobilization through the loan and the credit creation are also the essential components of the banking system. The allocation of the capital for alternative uses comprises of the credit flow that is required for the development of priority sectors in a nation, particularly the agriculture, and also looking after the social sectors like health, education, and other basic needs. The discussion on the banking sector reforms gets initiated by looking at its origin or the historical backdrop. So when we deal with the history of the banking sector reforms in any nation, we go to the pre-independence and the post-independence era. With reference to the pre-independence era, we basically go back to the institutionalization of banking which came up in India in 1786 with the establishment of General Bank of India. So this was the oldest Bank of India which started with the banking culture and also the necessity of channelizing the funds to mobilize the investment and also to accelerate the growth momentum. Then in 1806, the East India Company established the first presidency bank in Kolkata. So that means the East India Company was the first unit to set up the bank in Kolkata with the objective of ensuring the monetary stability, the credit flow, and also channelization of funds to investment. Secondly, in the year 1840 and 1843, two more banks were established, namely the Bank of Bombay and the Bank of Madras. And finally, the central bank of the economy or the apex bank of the nation, that is Reserve Bank of India, came into formation on 1st April of 1935 with the enactment 50 of the Reserve Bank of India Act of 1934. So the motivation behind the centralization of the bank or the establishment of the central bank goes in the preamble of RBI Act to regulate the issue of bank notes and keeping of reserves with a view of securing monetary stability in India. So most importantly, firstly with the currency, because at that point of time, printing of paper notes or printing of currency was one of the most priority of the economy to start with the banking system. Then we have the keeping of the reserves. These reserves consist of all the deposits which are not lended out, which are kept at reserves, along with the other reserves of the nation in terms of gold and foreign exchange. All these are important for ensuring monetary stability in India, because this monetary stability looks after inflation, looks after price sterilization, and also about the credit flow that the economy will go for. Now we concentrate on the post-independence banking sector reforms, because the discussion in the earlier slide was based before 1947. Now after 1947, we observe that the Planning Commission came up in 1950s and the banking system was expected to become more robust. So even after independence, banks were mainly urban oriented. So this was a cosmopolitan culture that was felt in the banking mechanism or in the banking terms and policies, which was urban oriented beyond the reach of the rural population. So basically the banking habits, the practice of keeping the bank deposit with the expectation of getting a return rather than keeping money in the idle form, and other functionaries of the banking system was basically being expected and to accelerate the economic growth. Secondly, a large section of the rural population were still under the clutches of the moneylenders who were exploiting them, and basically they were into huge debts. So a formal banking structure is required to address this level of exploitation so that the funds get rightly channelized. So government decided for the nationalization of the banks in 1969 and the second one in 1985. So banks were nationalized in the year 1969, which was one of the most significant development in the banking system post-independence. Now we open up with a question on comment on the backdrop of banking system in India. So in order to discuss on this particular question, we actually elucidate on post and pre-independence era. As it is observed in the pre-independence era, there was establishment of the apex bank, that is RBI or Reserve Bank of India, with the objective of issuing currency notes and ensuring monetary stability. Moreover, in the post-independence era, we invite on nationalization of the Indian banks, and also we go for some other developments in the banking structure, making it more urban oriented and also addressing the regional rural banks in the agricultural sector. Now we move on to the motivation behind the reforms. So when we talk about the banking sector reforms, what can be the underlying causes responsible for the reforms in the banking sector? First and foremost, we need to understand the reasons for the economic crisis of 1990s. It is observed that in Indian economy, all the policies that were undertaken in the pre-reform era, that is before 1990s, were basically inward oriented. This goes back to the growth oriented phase of 1950s, which was largely financed by industrialization or setting up of heavy industries. In order to do so, the Nehruvian model stressed on the dominance of public sector enterprises. Public sector enterprises were achieved to the commanding heights of the economy, given the full autonomy, and they were basically operating within a restrictive framework. This goes back to the Mahalanobis model of planning of 1956, and thereafter economy was taken up the momentum of domestic investment. Then there was an adoption of import substitution industrialization. That means the economy was closed and restrictive. All the commodities to be manufactured within India will be the substitutes, and they will basically taken up the domestic momentum. But this kind of trend continued in the years of 1966 to 1980s, when it was realized that the growth of the economy was taking place, but there was no issue of redistribution, that is equity. So the phase of 1966 onwards came up with redistributive growth, that is growth with the equity. But after that, the public sector enterprises were basically registering losses. There was lack of coordination between the development of industry and agriculture. In agriculture, there was an ushering of the Green Revolution, but the industrial development was given a halt. There was a deceleration and industrial stagnation. So moreover, it was felt that India was losing the momentum in the growth rate. However, at the beginning of the 1980s, there was an adoption of expansionary fiscal policy. That means expenditure was taken at the fullest, and it was reckless, and there was fiscal indiscipline. So as a matter of fact, it was realized that the economy had to spend more without any scope for income generation. So revenue generation was very limited, but on the other hand, expenditure programs were huge. So as a result of that, economy was getting into deficit burden or the debt burden, and that had aggravated into the crisis. So here, first of all, the difficulty that the economy was actually experiencing was an uncertain political situation. Because at that point of time, there was political turmoil, along with economic instabilities arising due to hyperinflation, instability in the interest rate management, and huge debt burden in terms of high fiscal deficit, mounting trade deficit, and falling of foreign exchange reserves. So the persistent fiscal imbalance was being seen in terms of deficit-driven growth, because growth was coming up, but that was financed by the deficits. So this was a perennial problem as started from the mid of 1980s. Inflation was double digit, which was hyperinflation, and finally the external sector was getting the shock in terms of balance of payment crisis, because imports were doubled and it was absolutely exceeding the exports. Moreover, the IMF and the World Bank, which used to provide loans, also have stopped on that basis, and there was huge debt burden which India was. So India was gradually falling into the debt trap. This boils down to the fiscal situation which was deteriorating throughout the 1980s. And this was one of the motivation for the Indian economy to usher in liberalization in the banking sector reforms or in the overall reform agenda. So the fiscal situation which was under stress during the 1980s reached a critical situation of 1991. So Indian economy was basically from a frying pan to the fire at the verge of 91 economic crisis. The external payment crisis was huge, high rate of inflation, and also the Indian economy had observed some kind of political instabilities. Then we have the momentum of the GDP. Because the growth of the real GDP, which once picked up near to 5.6% of GDP, it started falling down because of the lower industrial growth. Because industrial deceleration started, agriculture was already backward, and there was lack of coordination between these two sectors, and accordingly the growth had decelerated a lot. Industries were being affected because of lower focus on investment due to the non-availability of the inputs, and finally industrial economy was under recession. Moreover, it was seen that in 1991 there was acute oil crisis which was due to the Gulf War, and also the Indians who started their entrepreneurial skills by migrating to the Middle East countries, they also started stopping sending their remittances, and ultimately Indian economy was at the verge of huge crisis. So basically the deceleration of industrial growth, the dependence on the external debt or aid, and moreover the collapse of the markets in the Middle East made the reforms to be more acute. So this boils down to the question that what were the reasons behind the banking reforms? Definitely, firstly, the economic crisis, which was a twofold crisis: fiscal crisis due to the mismanagement in the funds, and secondly, the balance of payment crisis, which was due to the trade deficit that has come up. All these had forced the Indian economy to adopt macroeconomic stabilization package, and among the package, the most important priority was price stability, which can be done with the help of banking sector and financial sector reforms. This boils down to the discussion on the banking sector reforms which were adopted after 1990s, and how these banking sector reforms were also reflected even in current banking scenario. The first was basically in a total transformation in the structure, efficiency, and stability of the banking system. So when we talk about the structure, it's about the composition of the private banks, the foreign banks, along with the public sector banks which were operating, efficiency in terms of the profitability of the banking structure, in terms of the risk management and the debt management, and stability of the banking system is to continue to operate on a consistent performance basis without any other criteria of measurement. Moreover, the economic reforms have ushered in the issue of globalization to integrate with the rest of the world. So it is also the banking sector a challenge to cope up with the global economies in terms of the banking policies, in terms of the banking products, and in terms of international standards. So the most important part of the reforms was also integration with the international markets, because in a globalized world, all the markets are united through a common network, and so Indian banking system also should follow the same process. Secondly, the objective of the banking sector reforms is to become internationally competitive. This also brings in the amalgamation of capital market with the banking sector, because in terms of demat account, in terms of some other online transactions, and the entry of technological innovations. This also is instrumental for acceleration of the growth. Moreover, the reforms in the banking sector should also look at the efficiency and the stability of the banks, which are very much needed for the sustainable growth. Apart from this, there were other issues which were taken up in the banking sector reforms, mostly the phase of liberalization. Because earlier there were multiple clearance allowances, And also there were more rationalization of interest rate structure needed because multiplicity of the interest rates and multiple window clearance made the system to be more complicated. So to remove the operational rigidities in the credit delivery system, it can be done through a single window clearance to ensure allocation efficiency and achievement of social objectives. Here social objectives actually refer to the credit flow for education, the credit flow for health and other enterprises. So Indian banking system should be always treated at par with the international standards. Then only the competitiveness can be achieved in terms of risk management, in terms of capital adequacy norms and other prudential issues. These are basically the objectives that are taken up in the banking sector reforms post 1991. Moreover, it has been said that most of the banks are at the vulnerable positions because of the rise in bad debts. This is also one of the most important monitoring activity of the banking sector to reduce the vulnerability of the banks whenever the economic environment is at the shocks. Because a globalized economy can witness any kind of shock at any moment because of the transmission channels like stock market, like inflation rates, and also the foreign capital investments. So taking care of all these constraints, the vulnerability of the banks can be addressed by a proper governance in the banking scenario. Moreover, the banking sector reforms also should look after the income recognition, particularly by the people who are taking loans, about the nature of the defaulters if there is any possibility, and about the loans which are being disbursed in the different sectors. Provisioning norms, exposure norms, improve levels of transparency. This is very important in a digital platform, how transparency banking operations can be, and also the disclosure of the standards. This is very important in terms of accountability of the banking system. So this goes back to the question on the banking sector reforms, that what are the objectives of the reforms in the banking sector. The most important objective is to ensure price stability, is to attain the efficiency, change in the structure, and also the accountability of the banking system. Strengthening measures also explain reducing the vulnerability, look after the capital adequacy, checking the income recognitions, exposures, and also to improve the transparency. These are basically the overall objectives of how a banking sector reform can come up. Now we introduce on the first phase of banking reforms. First phase of banking reforms looks after the improvement and the modernization of the systems and the procedures in the banking structure. This refers to the banking delivery in terms of banking inclusion and also in terms of the credit management. Secondly, the competitiveness of the banks are to be strengthened so that it can respond more effectively to the emerging credit needs of the economy. Credit needs mainly from the social sector and also from the agricultural sector. To examine the cost, composition and adequacy of the capital structure, various institutions are recommended in this regard. That means all the financial intermediaries, the non-banking financial corporations, all should come up together to make the banking system more rigid and strong. Moreover, it is said, with reference to the first generation reforms of the banking sector, what had been the major emphasis? The first emphasis is on improvement in the financial health. So that is basically looking after the debt management and also taking care of the risk reduction strategies, like reducing the vulnerability of the banks whenever the banks are facing some kind of economic environmental issues. These also included in the prudential norms, taking care of the international thinking, because internationally or globally we can see all the banks are united. So in terms of that, introduction of the prudential norms are important. Then we have transparency of the financial statement. This is regarding the balance sheet of the banks and the institutions where all the disclosures must be done so that it has to be approved by the International Accounting Standards Committee. And also RBI should have a monitoring and a supervisory vision over the balance sheet of the bank, not only the central bank but also the commercial banks altogether. This also boils down to the emphasis on institutional strengthening. Because whenever we talk about the governance level of the banks, we mainly mean the institutional framework, which takes up after the personnel, the banking management, and also the officers and other staffs who are involved in the banking system, in terms of a proper recruitment and in terms of the talent which are being recognized and utilized in the proper manner. This also refers to some of the licensing that the new private banks are coming in. Also, the public sector banks and the private sector banks should cooperate and actually act in a common forum. This boils down to another important concern in the first generation reforms is on the asset reconstruction fund. This is regarding the dealing with the bad and the doubtful assets so that the funds can be cycled and the new productive asset can be built on. This also takes care of the independent auditors who can be appointed to go for an auditing on a regular basis. So on the basis of this, we can take up a question on what are the major emphases of the banking sector reforms, transparency, institutional strengthening and asset reconstruction fund as far as the first generation reforms are concerned. Now we go for the second reforms which has come up in the year 1998 under the chairmanship of M. Narasimham, who has actually witnessed on the banking trajectory of the performance and explain how the Indian financial system can become more internationally competitive. This basically refers to that the entire portfolio of the government securities should be taken up to the market risks to be actually monitored, and some of the approved securities will be taken up in concern. The report also mentioned that the risk weight for the government guaranteed advance would be the same as for other advances. That means government guaranteed advances also carry the risk factor that has also to be understood by the banking sector, and accordingly risk management policies to be proposed. So we can take up a question on highlight on the motivation behind the second generation reforms, particularly to look after the competitiveness of the Indian financial system, look after the risk management and the monitoring of the non-performing asset, which has been one of the most important concern which erodes the profitability of the banking structure. Now we move on to the major issues arising in the second phase of reforms, which is till date. Firstly, deregulation of the branch licensing. So the committee recommended that the branch licensing be abolished and the matter of opening branches or closing branches left to the commercial judgments of the individual banks. Because with the advent of the banking inclusion, more banking branches are being opened across the corner of the country, and this will allow them to shift their existing branches, to make the branches more specialized, particularly in terms of foreign banking, in terms of digital banking. Also, the kind of the rural branches can be converted into satellite offices who can be monitored from a centralized mode. Some kind of counters, administrative units can come up in form of a kiosk with the help of a capital intensive technology. So all these are making more liberal and deregularized in the second phase of reforms. Secondly, the concern for capital adequacy. This will work in terms of the Basel norms, which is a standard measurement which uses a building block approach in which the equity and the risk positions are calculated separately. For example, any deposit or any kind of fund which can end up into the bad debt, so any kind of expectation or any kind of probabilistic calculation can be done so that the risk management can be taken up properly. And this actually refers to the capital adequacy standards. So in this particular module, we actually focus on what had been the role of banks in the Indian economy or in any nation. Secondly, to look after the banking sector reforms, we make an evolution with respect to the historical background of pre-independence era, where we observe in 1935 there is establishment of the Reserve Bank of India with the objective of ensuring monetary stability. Then in the post-independence era, it has become more urban oriented, and it has looked into more and more branch openings. Then we invite on the first phase of banking reforms, which had been on liberalization, entry of the private sector banks, and along with the public sector banks to operate. And the second generation of the banking reforms was mainly on the capital adequacy standards, mainly on the auditing standards, and to ensure transparency in the banking sector. So moreover, with the goal of globalization and united across the world, the banking sector reforms should be more and more challenging, and it should take up all the challenges that are observed in the current economy, which is a globalized economy in the international market.